The 2022 Great Depression. Now, I've heard a lot of people talk about the next Great Depression. Potentially, this is it. And if that's the case, you probably don't want to be invested in stocks. Now, I am not in the camp of this is the next depression, but I see why people are saying that. You've been falling consistently in the NASDAQ for the last 5, almost 6 months now. And from peak to trough, you have actually dropped over 31%. That is actually worse than the drop of 2020 when there was a 100-year pandemic. We only dropped about 30% from peak to trough in 2020. So I see people's concerns here, and I understand that things are not really going back to normal, quote unquote. Energy prices are very high. Inflation is not going down. The Fed is not your friend. All of the things that you would think you would need for a depression are seeming to be here and happening. But there's really not the underlying cause of a long-term downtrend or a depression here in the markets. I'm going to use the word, but I think a lot of this is transitory, and there's really one thing you need in order to get a depression or a 2008 financial crisis again. So we are going to dive into that here in this video, go over all of my thoughts behind a depression, or just sum it up to a long-term downtrend in the markets. Hit the like button, subscribe to the channel if you guys find value out of this video. Feel free to share this video as well. I hope to give you guys a different perspective on this and provide you guys value that you probably will not see anywhere else. So let's get into the information here. And first thing that I want to point out is that I might be wrong on this. I might be 100% wrong in this. It's really up to you to come to your own conclusions. If you think there is going to be some degree of a financial crisis or depression or just 5-10 year long downtrend in the markets, which can happen, and they have happened about twice in history, then you probably don't want to be invested in stocks, and that's your own personal decision to come to. I will fully continue to buy the dip in a lot of the companies that I personally like. Now, you guys got to remember, like I just said, during the crash of 2020, we have now dropped more than that. The 2020 crash was more violent and it bounced back very aggressively. Why did it bounce back that aggressively? Well, the Fed was your friend. The Fed said, hey, we're going to cut rates. We're going to do what we have to do to support the financial system. That's why you typically do see these V-shaped recoveries when markets do crash, whether it's the NASDAQ, the Dow, the S&P. V-shaped recoveries are always due to the Fed. When you don't get a V-shaped recovery like 2008, and we'll pull up the S&P because it's a little bit easier to see these violent crashes, but if you pull up 2008, you'll see that it was a crash that lasted a long time, and then it took a while to come back even when the Fed was our friend. Because what was the common denominator during 2008, and what actually caused 2008, and why is that different than what we're seeing now? And we'll talk about the Great Depression as well. But what happened during 2008 was, obviously, mortgages failed and the subprime mortgage crisis. But it actually went a lot deeper than that. So essentially, in a nutshell, what was happening is that anyone could get a loan. Your dog, your baby that was just born, like anybody could get a loan. Strippers were getting 5-10 houses. If you guys have seen The Big Short, then you can definitely relate to that. That's literally what happened in the movie. But it wasn't that 12% of mortgages failed. That's not what caused the 2008 financial crisis. A lot of people think, yeah, people just stopped paying their mortgages. Banks went under because of that. Banks did not go under because 12% of people stopped paying their mortgages. That was the default rate, about 12%, which is very high still, and that would cause a lot of financial pain. But that's not the reason why Lehman Brothers, Bear Stearns, and multiple other banks went bankrupt. No. They were giving out these bad loans. They were packaging them together and basically pressuring Moody's, the S&P to rate these securities as top of the line, as AAA credit ratings, so then they could charge more for them. Well, at the same time, they figured who doesn't pay their mortgage, right? And if you go to the federal funds rate, which we will pull up right now, essentially what was happening and why Michael Burry could actually see this coming from a mile away is during the whole time they were giving out speculative loans, the Fed was raising rates to 5.25% on the federal funds rate. Whereas when all these people were going out and getting speculative bad loans, just call it bad loans, bad credit scores, dogs, strippers, all of that, they were getting these teaser rates, adjustable rate mortgages. They're called ARM mortgages. So they would get a teaser rate for 2 or 3 years at, say, 2 or 3%. And then the adjustable rates started to kick in, end of 2007, beginning of 2007. And then your mortgage payment went from, let's say, $500 to $1,500. People stopped paying their mortgages. But let's go back to them collateralizing these bad loans, bundling them together, taking, say, 1,000 bad loans, bundling them together, rating them as AAA loans, and then betting on those bad CDOs, collateralized debt obligations is what they're called. That's the real problem. For every $1 billion worth of mortgages that actually got defaulted on, there was roughly $15 billion of bank money behind those betting on them. Kind of like you could put this into the realm of, let's say, Apple. Let's say Apple is really just a fraudulent company and everybody thinks it's the next big thing. The stock's going to $10 trillion in the next 2 years. Everybody has options on that. Everybody has investments in them. They run the stock up like nobody's business to let's say 5, 6, 7, 8 trillion dollars, right? And there's derivatives on that of, say, another $10 trillion. Well, if Apple were to go under, you're looking at a Great Depression again, right? That's kind of what happened here. Whereas if Apple failed now, sure, it would suck, but there's not, multiple times the float betting on derivatives on that company. So it was really derivatives that crushed the markets during 2008 that really messed a lot of things up. It wasn't necessarily people defaulted on mortgages. So you need to see a systemic problem. You need to see real issues in the financial system. Whereas right now, you're not seeing that. You're not seeing banks that are, going out and doing all this speculative shit. It's quite the opposite. If you've tried to get a mortgage or you've tried to get a business loan over the last 2 years, it really hasn't been possible. Now that rates are going back up, they're going to want to stimulate stuff. They're going to want to try to get people in houses. So they're going to try to do other things and give out loans. So that might start to happen. But as of right now, not happening. Now, it was essentially the same thing that caused 2008 crisis that also caused the Great Depression. A couple other key differences, though. The causes of the Great Depression were the stock market crash of 1929. People did not trust the stock market after that, and that's why the markets took like 10 years to actually recover. The collapse of the world trade due to the Smoot-Hawley tariff, government policies, bank failures, and panics, and the collapse of the money supply. Now, there was a lot of other smaller things that also helped, and I think the only real thing that is relatable to now is definitely government policies, right? A little bit different. Government policies then were obviously not the same as what they have been now, but the government has done some pretty bad policies, and I think anyone can agree to that. But by and large, we're not seeing the same systemic problems that we've seen during the Great Depression and 2008 financial crisis. The real long-term downtrends in the markets, you could say the 70s, 80s as well, those were pretty extreme downtrends in the markets. The average bear market during the 70s and 80s lasted over 630 days, so almost 2 full years, but that was really caused by going off of the gold standard in 1971, as well as the Vietnam War and a lot of other issues related to that. Obviously, if you went from being able to turn your money into a bank and get physical gold, and now you're no longer able to do that, people are going to question the value of that paper dollar. So little bit different nuances here to everything, but the main thing is systemic risk. Some degree of systemic risk causes markets to go down and stay down for quite a while. Now, I'm not going to be naive to you guys. The biggest thing, or really the two biggest things that could potentially cause the markets to go down and stay down for a very long time, really it's two things. Because we know inflation, that's going to go away. We know China will eventually open up. Those things will be transitory. And I know people don't like that word, but we're just going to use it for the sake of this video and because, that's just the term of 2022 so far. But the two things that could be a real issue is going to be Russia. If they really want to push this thing into World War III, that's obviously not going to be a good thing, at least for possibly a couple years after that. Markets do tend to go up during, wars. World War II, the markets actually started to rebound and average, 7-8% every year World War II was actually going on. But energy prices, if this thing drags out with Russia and Ukraine and energy prices continue to go crazy, after all, gas pumps are being programmed to read $10 a gallon for gas, that could drive you into a longer term market downtrend. And it really comes down to, is the government going to let that happen? The government could come out tomorrow and say, yeah, we're going to open the Keystone Pipeline. We are going to start pumping oil, and oil would substantially fall and we would not get to those $10 prices. Now, I'm not confident the government is actually going to do that. So that's why I'm saying this is probably the biggest risk factor that we have. And this is what could potentially drag us into a multi-year downtrend in the markets if energy prices did go to, say, $8 to $10 a gallon of gas. For me, I'm saying that's for Michigan. For California, that could be like $15 a gallon for gas. That's what could really, really hurt the overall economic system, because for every dollar gas goes up, it's like $20 billion less money people have to go out and buy things in the real economy. If gas does go down, which it's really 50-50 at this point, but I think eventually it will, after probably another big spike, maybe close to $6, $7, $8 a gallon, I think it'll come down after that. And Russia can't afford to continue to have this war, then we should be okay. We should be okay if gas can go down, if energy prices can go down. If not, that's where you could be looking at a pretty bad situation for the overall consumer, for, stocks like Apple that control the overall markets. But by and large, there's no systemic risk right now, besides oil and the possibility of World War III. As long as those things don't happen, as long as energy eventually goes down, even if it takes a year, we will be fine. And this is the time to buy the dip. If World War III starts, potentially it is still time to buy the dip, as long as you don't get drafted and there's not a nuclear apocalypse, right? So those are really the two things right now that could cause a longer term downtrend in the markets, besides just the obvious, the Fed raising rates. The Fed is not your friend. So this is as to be expected for quite a long amount of time. We might actually just start to trade sideways here, in between 360 and 380 until the Fed does U-turn. The glorious thing about all of this, if you have a long-term outlook, which if you're buying stocks right now, you have to have a longer-term outlook of at least 3 to 10 years, which is still like midterm to me. Like long-term outlook is like 20 years in my personal opinion, but depends on other things. Markets could trade sideways. And then eventually when the Fed does U-turn, when inflation does go down and the Fed has done enough tightening, that's when the markets will see this V-shape like recovery. But it's not going to happen probably for another 6 to 12 months. So that's really what we're dealing with here. I don't think we're dealing with a 5 or 10 year long downtrend like we've seen during the financial crisis or during the Great Depression. And it all comes down to the systemic risk. Banks are in good shape. The overall consumer, minus inflation, is not doing all too bad. So those are pretty much my thoughts. I think this is a generational buying opportunity. Not too long or like ever in the past, you've got crashes since 2008. The markets have went down and stayed down, meaning you have a lot of time to acquire new positions. You can go out and start to make more money today, and for the next year or however long it takes to bounce back, you could buy the dip in, all of your favorite stocks and have a lot of time to do that, put a lot of money to work, and then eventually we will bounce back up. But, during these V-shaped crashes, you only have what is available to you as far as capital is concerned to go out and buy your favorite stocks. So you can't put as much money to work in these downtrends as you can during a 6-month long downtrend. So I do think this is probably the wealth creation turning point in a lot of people's lives, and I hope people do ultimately make the best out of it. And hopefully this video does serve you well and offers you a different perspective here, because I've seen a lot of people talk about a Great Depression or 2008 financial crisis, but we are not there. There is not systemic risk besides the possibility of nuclear war, which is always on the table when you're dealing with and have the situation that we have right now. I think that's not very likely, though. I will say that. Energy prices, that's a different scenario. Depending how long Russia does drag this on, that's going to be a big problem. But I will tell you, the day that they do end this special military operation in Ukraine, the markets will be up 3 to 5% that day. And it'll probably lead into a 15% rally to the upside. So that is that. That's what you guys need to know. If you guys found value out of this video, hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. Thank you guys for tuning in, and I will see you in the next one.